Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. I'm recording this latest update on the US business cycle in the afternoon of Monday, April the 8th. And several things have happened. We've most recently had a positive non-farm payroll report. And so the question is, well, are we heading into recession? Or are we coming back up? Was this just a little lull here cyclically? Has the Federal Reserve overreacted? What does it all mean, and why do we care? This is the why do you care chart. Historically, in recessions, the equity markets, risk assets more broadly, have significantly underperformed, and that's why you kind of want to know whether you're in expansion or recession. Now, obviously, if you're heading towards the late phases of an expansion, maybe you just want to take that into account, since one doesn't have a crystal ball as to when this expansion is going to come to an end, even if we might suggest we have this crystal ball here in this book, and obviously we don't. This is food for thought, but leading economic indicators in the US have been coming down, but they're still here in positive territory, significantly so. And if you go here back several decades, those had historically been far more negative. So based on that metric, at least, things are okay. But of course, as the trend changed, we saw that in recent months, treasuries had rallied, rate hike expectations had come down, and many people were saying, oh my God, this economy is heading to the doldrums. So the question is, when actually do you want to take precautions? But at the same time, after that scare we had in the equity markets, as we talk, we're not so far away from all-time highs in the S&P. Yield curve steepness. Many market participants mesmerized by this, that if we were to go inverted on the yield curve, here is the 3-year versus the 10-year. We use that horizon, by the way, simply because of the availability of data very far back. People have pointed out that the very short end of the yield curve, there's been inversion. The inversion means basically when shorter term yields are higher than longer term yields. That's an expression of tightness in monetary policy and possibly a precursor to a recession. We call it a necessary but not necessarily sufficient condition. If you look here in the mid 60s, for example, the yield curve was inverted, and the recession did let us wait for an extended period. Purchasing manager indices. First, the US, and as you can see here, the manufacturing PMI has ticked up a little bit. The non-manufacturing PMI, services PMI, has come down, but firmly in positive territory. What has gotten people talking very extensively is that some global purchasing manager indices, and here the blue one notably is the German one, they have gone deep down. Obviously, Germany very export driven, and as such very vulnerable to the trade jitters, possibly also to Brexit. On top of that, I'd mentioned some very short-term localized issues. They're still not worked through entirely in the automotive sector, where they just couldn't get car registered because some testing equipment wasn't ready for the European auto industry. But at least as noteworthy, and some people think this 50 is a magic line. Of course it isn't, but everybody, including us, does focus on it. Chinese PMI, Chinese Purchasing Manager Index, that had dipped below 50 has climbed above 50 again. And so the question, and the Chinese have done a lot to try to stimulate the economy. They have done actually many things. The one thing they haven't done is lower interest rates. Instead, the Chinese lower the reserve requirements in an effort to boost economic growth. The reason they don't lower interest rates is because they like to have this reasonably stable exchange rate. And of course, it's not entirely stable, but they are very reluctant to take down interest rates, which would be the bluntest and probably one of the better measures in my view. But they are scared, especially in the context of these trade talks, to do something that would jeopardize the value of the currency. Somebody pointed out to me recently, and that is right, the Chinese have worked hard to get rid of some excesses outside of the banking system in the shadow banking sector. And some of it is good, that there were some odd things happening. What isn't good is that to get credit these days, you have to go to the big banks, and they're not equipped to give risky loans. The shadow banking system fulfilled a very important role, and you can't just get rid of the unregulated market without having a decent substitute. If they want the Chinese economy to grow sustainably, in my view anyway, you want to develop credit markets that serve not just the state-owned enterprises, but the entrepreneurial Chinese. And the good news is there are a lot of things they could do to improve the system. But for the time being, with the stimulus they have pumped into the economy, and they don't want to do what they did before, just build high-rises and highways exclusively. They've possibly turned the corner, so they've done lots of little things. And with that, of course, that might give also trickle effects to the rest of the economy, and notably the German economy might be very sensitive to that. I do scan German news almost on a daily basis, and there is, while some numbers have come in very bad, there is increasingly chatter that we've reached the bottom of that. Job gains. We might recall a month ago, this very meager job creation number of only 20,000 it was, and now rebounded last week to 196,000. If you look at the trend, these low numbers do come in periodically. The fact is that at 196,000, and here the 3-month average is in the black line, also being up there at 180,000, that is solidly above potential. And what that means is that we keep pulling in people from the sidelines. As we keep pulling in people from the sidelines, at some point, and nobody knows when that point has come, it is going to be very difficult to pull in people from the sidelines, because people don't want to move from the sidelines. And what we're talking about is discouraged workers, people who had been on disability, for example, for whom the barrier to entry, so to speak, is higher. There has been a stream of people coming back. The question is how much supply there is. At least that's a question I am asking. I do believe the Fed should be asking that question, but the Fed is not asking that question. The Fed does not seem to be concerned, shrugging off that concern and saying that, well, even if we have difficulty, which would translate potentially to inflation, we know how to deal with that. To me, that's a very dangerous road to be on. And indeed, if there's one risk that's underpriced into the market, is that risk that we're squeezing out too much from this labor market. And with that, here we are at very near record low unemployment levels. And the reason we show this moving average is that as we've kind of breached through that moving average, that's often a sign, a precursor to a recession, as you can see, not immediately before. And so we're hovering there near the lows. For what it's worth, that uptick here coincided with a government shutdown. And then here we have the U3 model as well, with the San Francisco model. I'm not going to comment on this one too much. There is the Congressional Budget Office has its own measure on whether we are running above capacity. This suggests we are. Similarly on the output gap. I like this measure, the Atlanta Fed GDP Now indicator, quite a volatile indicator, but more often than not gets it right. And basically what that suggests is that we did have a pullback, but we are bouncing back here already. And so to me, that is quite likely that we actually had this little lull here and are bouncing back. Credit cycle. Do look at separately at the premium charts that Nick has created, which dives a little bit more detail, shows the auto sector as well. This one here focuses more on the kind of the greater numbers, that includes mortgages, and there people have been quite good. Obviously, a little bit of an uptick. If you look at some of the more sensitive data, there has been a little bit more of an uptick. Now, keep in mind, talking about mortgages, that mortgage rates have plunged again to very low levels, which might again be a stimulus in the US. Consumer confidence is doing just fine. Lending standards. So this is a metric here. We're still at very low levels here, but those who want to see the glasses half empty, and if you have followed me for several years, I have certainly been in that camp at some point, but maybe I'm on the camp half full, the half full camp here. The credit standards lending standards have tightened a little bit, and by the way, that is the whole point of hiking rates, but that may well be part of the reason why the Fed has decided to pause. And then high yield spreads, though, are very contained. Building permits, obviously interest rate sensitive, that had come down a little bit. Maybe, who knows, the low mortgage rates might counter that trend. And so here you get the checklist that that Nick puts together. Obviously, please download the PDF at merkinvestments.com/research to get a better idea of it. But let me make here some additional comments, and most notably, we focus a lot on the consumer. Now, the consumer spending, some people are pointing out, is actually reasonably stable, that recessions may be caused more by short-term shocks to inventory or by business investment dropping off. And so quite often recession can come more abruptly because of an external shock of sorts. And of course, that's always the case, but part of the reason we show these charts is to show you the longer term trends. If you have a very short-term shock, there's very little you can do to prevent that, obviously. But what I'm showing here, and the reason why I'm very interested in this, one of the reasons is that I do think this economy is running at above capacity, and the Fed is not concerned about it. If you talk to anybody but myself, people say we're going to have a rate cut later this year. Somebody corrected me earlier today and said about 35% of economists see a rate hike later this year. I didn't verify that number, but it appears I'm not the only person. And I don't have a problem with going against the stream. I often do that. What gets me concerned is that I hear nobody at the Fed express those concerns. Historically, you have a majority at the Fed, and I have no problem with the majority saying, hey, listen, guys, there's maybe downside risks. But then you have some hawks historically that say, wait a second, not so fast. We have very low unemployment. We have pulled people from the side for an extended period. How much more space is there? Shouldn't we be a little bit higher than the lower end of the neutral range? Shouldn't we be in the middle of the neutral range or the upper range of the neutral range? I don't hear any of that, and maybe that's because these the inflation folks have been wrong for so long that they have been silenced. But to me, there's a grave risk that one sets oneself up for a policy mistake. And obviously, policy mistake would be that inflation does come up and that the Fed has to seriously hike into a slowing economy in order to fight that, meaning the stagflation type of scenario that may well come. Anyway, hope you enjoyed it. Give us feedback. Look at the premium charts. Nick added several new premium charts, and spread the word that these reports are available. Thanks, then. Have a good day.